Welcome to the advisory group's economic update at the end of the first quarter for 2026. Let's first start with some introductions. My name is William Glenn, and I am a client services associate at the advisory group. Our speakers tonight for this presentation are Manny Chinche, a senior advisor at the advisory group, and Brent Beverly, the president of the advisory group. Both of them are certified financial planner practitioners and wealth advisors at our Diamond Bar branch in the California office. At our firm, we partner with clients and believe an educated client is our best client. While we always try to do our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can help them make an informed decision. Our contention is that the more you know how things work, the more you will enjoy working with us. We want you to know what is going on. As a reminder, it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Today's presentation will be focused on investment planning and equity markets. Now, to get us started on the core of our workshop, let me bring up our first speaker, Manny Chinche. Manny?
Thank you, Will. As 2026 began, equities carried forward the momentum and investor optimism that defined much of 2025. Markets entered the year on solid footing, supported by expectations of interest rate cuts, continued earnings growth, and improving market trends. However, that favorable backdrop began to shift as the quarter progressed, primarily due to geopolitical tensions in the Middle East and evolving expectations around the Federal Reserve's policy path due to inflation. These factors fueled concern and volatility. But by the close of the quarter, the market rallied and regained some losses, with the S&P 500 closing at 6,539. However, even with that rally, the S&P 500 still ended down over 4% for the quarter. The Dow closed at 46,254, and again, despite one of the strongest single-day rallies in March, was also down about 4% for the quarter. For January and February, inflation continued to show some incremental signs of easing. The February Bureau of Labor Statistics data for the year-over-year core consumer price index, less food and energy, rose as expected at 2.4%. During the quarter, the U.S. economy remained remarkably resilient. Labor markets continued to show strength and consumer spending remained healthy. This played into the Fed's decision to hold rates steady. After the quarter closed, on April 10th, the March CPI numbers were released, and as expected, the headline CPI rose to 3.3% year over year. This was because the impacts of the new Middle Eastern war and surging energy prices were starting to surface. Now, the Federal Reserve is still looking for an inflation rate of 2% or less, and with energy prices rising, this may not be accomplished for some time. Inflation numbers are a subject we need to watch carefully over the next quarter. The federal funds interest rate during the first quarter remained stagnant. At the March Federal Open Market Committee, the Fed adjusted some previous views on the economy, notably a slightly faster pace of growth and higher inflation projections for the remainder of 2026. But so far, they are keeping their rates steady at a range of 3.5% to 3.75%. As financial professionals, of course, we always monitor interest rates. U.S. Treasury rates also experienced some volatility in Q1 2026 and generally rose. This was particularly driven by persistent inflation concerns, continued economic growth, and geopolitical tensions that we're experiencing. As the quarter ended, the 10-year Treasury yield was 4.35%, the 5-year Treasury yield was 3.97%, and the 30-year yield was 4.91%. Bond behavior continues to hinge on the direction of interest rates. Should the Fed pursue additional rate cuts, existing bonds could appreciate in value. Conversely, expectations of slower easing or persistent inflation pressures could push yields higher. For investors, we believe that bonds continue to play a meaningful role in portfolio diversification. While recent volatility highlights that bonds are not risk-free, especially in a rising yield environment, they can still provide relative stability compared to equities during periods of market stress. However, please remember that while diversification in your portfolio can help you pursue your goals, it does not ensure a profit or guarantee against loss. Now, the elephant in the room is the price of oil. Due to the conflict in the Middle East, oil prices have risen significantly, and everyone's feeling the squeeze. From personal transportation to the price of moving foods and goods, the consumer price index could continue on an upward trajectory should oil prices remain elevated. Now, the quarter ended with possible optimism around easing geopolitical tensions, and long-term analysts think that eventually energy prices will correct themselves. The situation in the Middle East will take some time to sort its way out, and we'll be keeping a close eye on this matter. Now, safety still comes at a cost, and sadly, many major banks are still only offering low interest rates to savers. According to Barron's, the average bank money market rate on March 30th of this year was just over 0.5%, and the average 12-month CD rate was 1.85%. For anyone who's interested in exploring sources of better interest rates, please contact our office. Now, to close things out, allow me to bring up Brent Beverly. Brent?
Well, thank you, Manny. In our presentations earlier this year, we noted that we expected volatility to occur during the year. Now, as we expected, as the quarter closed, volatility remains prevalent and is likely to be here for a while. Now, while we're still technically in a long-standing bull market that has had several pullbacks, if things get rough, the news, the media could use a lot of terms, and we want to remind you of some of the most common terms that are used when it comes to volatility. A dip is a short-lived downturn of usually less than 5% from a sustained longer-term uptrend. A correction is like we experienced in April of 2025, about a year ago. It's usually a 10% drop in the market from recent highs. And a bear market is a long, sustained decline in the stock market, typically of 20% or more from its recent high. Now, while not enjoyable, these movements are just a regular part of the investment experience. We typically say crashes and corrections are uncomfortable, but not uncommon. While investors are still optimistic in this market, market volatility is very likely to persist. This makes discipline and perspective essential to investors. So as you can see from this chart of almost 40 years and many crises that occurred during that time, the market doesn't move in a straight line. In the past 38 years, investors have experienced multiple downturns in equities created by external forces. Now, similar charts that we've used before show the same kind of long-term results for 10-year, 20-year, 30-year, and 40-year periods. But one thing that has been constant over this period is that those who've invested well and continued in a long-term perspective saw greater results. Even in the most recent downturn of April of 2025, that was the last big downturn that we saw, when markets reached an uncertainty around tariffs, we experienced a correction. And by the end of the year 2025, equity investors who demonstrated patience and discipline have been rewarded with record highs. Let's look at some key takeaways that we want to walk away from today's discussion with. In summary, uncertainty and volatility remain and are likely to be here for a while. However, equities continue to be resilient, surprisingly so here. This market resilience has been fueled in part by continued growth in, say, artificial intelligence, AI, a resilient labor market, consistently strong corporate earnings, and the Federal Reserve's anticipation that eventually we should see future rate cuts. Now, that said, the Fed kept interest rates unchanged. They remain at 3.5% to 3.75%, as Manny noted. The Fed noted this last time that while they remained stagnant in the first quarter, we could still see rate cuts or even rate increases later this year. That's really stand by to stand by. Inflation increased, but at expected rates, so no big change there. Traditionally viewed as a safer haven, bonds experienced some volatility of their own during this first quarter. We talked about that earlier. Now, we're going to continue to monitor key economic indicators. We're going to be looking at the key items that continue to fuel volatility, things like oil prices, the path of inflation, interest rates, geopolitical uncertainty. We've certainly seen that. Focusing on your long-term goals and staying the course with a well-guided plan can help you to stay grounded and confident during these times of uncertainty. And it's important to remember, we're here for you. Please reach out with any questions or concerns. Your financial well-being is always our priority. We appreciate your focus during this presentation. Please pause to read through these disclosures so that you know what's going on. If you want to reach out to us, here's our contact info. Please note the email address. We will post this again in a couple of minutes. It's important to remember that you are our priority. We're thankful for this opportunity to assist you with your financial needs and financial knowledge. At our firm, clients come first. Your health, your well-being is always our priority. One of our major advantages as a financial advisory firm is our advisory group team. TAG, the advisory group, our TAG team. Now, we're proud of our TAG team and the high-quality service we all provide. Now, you may notice some new photographs here. Our TAG team keeps growing. Here's the information for you to reach us. We're glad to be of service. Please reach out to us if you have any questions, comments, or want to meet with us. Have a wonderful day and a great year. We want you to be happy, healthy, safe, secure, and prosperous. Thank you for attending.